Hi, and welcome back to this set of videos looking at the simple economics of foreign exchange and exchange rates. In the last video, we looked at the sources of demand and supply for a currency like the Australian dollar. Why would people sell euro and buy Australian dollars? Why would people sell Australian dollars to buy euro? In this video, we're going to take a slight detour and use the definitions from the last video to look at three things: the current account, the balance of trade, and the capital account. We'll ask what they are and what they mean. Just a reminder from last time, there are three reasons why someone overseas would sell their currency, like euro or yen, and buy Australian dollars. The first reason, they want to buy Australian goods or services. They want to buy some exports from Australia. Second reason is that they want to pay an Australian some income, maybe a dividend that they have to pay to an Australian shareholder. It's Australian income receipts. Thirdly, they may want to buy an Australian asset. That's foreign investment in Australia. And similarly, there are three reasons why somebody in Australia might want to sell Australian dollars and buy foreign currency. They might want to buy some goods and services from overseas. That's called imports to Australia. They might need to pay an overseas person. Say they need to send some money to a grandparent who lives overseas. They need to sell the Australian dollars, get the overseas currency to make the payment to their grandparent. Or thirdly, they might want to buy some overseas assets. They might want to buy some US shares. They need to sell Australian dollars, buy US dollars to buy the US shares. Now, to remind you, all purchases of Australian dollars fall into one of the three categories on the left-hand side of this slide. And all reasons to sell Australian dollars fall into the right-hand side of this slide. Let's start off by looking at exports and imports. We have our first definition, and that is simply that exports minus imports is simply called the balance of trade. For our second definition, let's look at exports, income receipts, imports, and income payments. Exports plus income receipts minus the sum of imports and income payments is simply defined as the current account. So, if we talk about Australia's balance of the current account, we mean Australia's exports and income receipts less the sum of our imports and income payments. Let's look at the balance of trade and the current account for Australia over about the last 25 years, remembering we're doing this at the beginning of 2018. First, we have this orange line here. It shows the balance of trade, or the trade balance, same thing. You'll notice that sometimes it's positive and sometimes it's negative. It's positive whenever Australia exports more than it imports, and it's negative whenever we import more than export. The green line shows our income receipts less our income payments. It's called the net income balance. Now you'll notice that it is always negative. That reflects the fact that in the past there's been a lot of foreign investment in Australia, and so when we pay dividends or return profits to overseas owners, that means that we sell Australian dollars to buy the foreign currency to pay the foreign investors. That's an income payment, and overall our income payments are larger than our income receipts, so that green line is always below zero. And if you add up the orange line, the trade balance, and the green line, the net income balance, you end up with the current account balance, and that's given by the blue line. And again, you'll notice that the blue line for Australia is always negative. It goes from about 2% of nominal gross domestic product down to at periods of time being around 7 or 8% of gross domestic product. Because the current account balance is negative and has been so since the early 1990s for Australia, we say that Australia has a current account deficit. Now, let's look at foreign investment in Australia and foreign investment by Australia. Foreign investment in Australia minus foreign investment by Australia is called the capital account. This is sometimes divided into two things: net capital inflow and change in government reserves. So government holdings of, for example, foreign currency and gold. This diagram shows the net capital inflow for Australia. The black line is the total net capital inflow, and you'll notice that that black line is positive pretty much for the last 20 years or so. That means that Australia is a net recipient of foreign investment, and it's been broken down here just into investment in Australian equities, i.e. shares, and investment in Australian debt like bonds. And here we have the Australian government reserves. These are given as the total level, but you'll notice they've been increasing pretty steadily since around 2008, so that the government's holdings of reserves have been going up. In other words, the Australian government, usually through the Reserve Bank or the Central Bank of Australia, has been selling Australian dollars to buy foreign currency or to buy gold. Now for our final definition, and that's going to be the balance of payments. The balance of payments simply equals the current account plus the capital account. But let's think about that for a minute. Remember that the current account is equal to exports plus income receipts minus imports and minus income payments. While the capital account is foreign investment in Australia, take away foreign investment by Australia. So notice that the balance of payments is just all purchases of Australian dollars, exports, income receipts and foreign investment in Australia. Take away all sales of Australian dollars, imports, income payments and foreign investment by Australia. But notice that the balance of payments is simply equal to all the reasons why we would have people buy Australian dollars, exports, income receipts and foreign investment in Australia. Take away all the sales of Australian dollars, imports, income payments and foreign investment by Australia. But remember one of our simple facts about markets. As long as there's no force involved, you can't buy something unless someone sells it. And you can't sell something unless somebody buys it. And the same holds for markets in currency. You can't sell an Australian dollar unless somebody overseas buys it. And you can't buy an Australian dollar overseas unless someone sells it. So the number of Australian dollars bought and the number of Australian dollars sold at any point of time must be the same number. They must equal each other. Or in other words, at any point of time, the balance of payments has to equal zero. A couple of final things. First, note that this simple result, that the balance of payments always equals zero, immediately gives some policy implications. For example, you can't just increase exports as a country. If you increased exports, then the balance of payments would become positive. Something else has to change to bring it back to zero again. For example, if you try and increase exports, then you may end up also increasing imports. We're going to see later on exactly how that can work and why, buy Australia or buy local campaigns often are a complete waste of time. The second thing to note is that, strictly speaking, what we've done here applies to countries that have a floating exchange rate. Australia, Canada, the United States, the United Kingdom, all of the Eurozone, for example. So a lot of countries. Some countries have government intervention in the foreign exchange market, and they have a fixed exchange rate. And things are slightly different there. We're going to again get to that in a later presentation. But that's enough for now. Talk to you next time.